You've got potential war with Russia and Ukraine and involvement with NATO. You've got oil spiking to over $93 a barrel as a result. And this past week, we saw the consumer price index reflect a 7.5% inflation rate here in the United States. And all these things are connected here. And all of these things could lead to a stock market crash or further downside selling at the very least. So how do you plan for the week ahead? What levels should you be watching in the stock market? We're going to talk about all that and more. But first, make sure you pound that like button and subscribe to this channel so you get notified anytime I do a new video in the future, including live streams and podcast episodes. Plus, click the join button down below so that you can get all my stock market research each and every day. Now, let's get into the charts here. Let's talk about the stock market. The S&P 500, it was down 1.8% this past week. You had the NASDAQ 100 that was down 3%. Then you had the NASDAQ composite, actually a little bit better, which tells you there that it was more the FANG stock showing weakness than the NASDAQ composite as a whole. It was down 2.2%, while the wild card was the Russell 2000 index up 1.5% and up for a second straight week. So what is that telling you here? Well, you're seeing a lot of capital flow out of the tech, out of discretionary, and out of utilities into energy, materials, and telecom. Now, if Russia does end up invading Ukraine, what does that mean? Well, there's probably a good chance you're going to see at the very least sanctions from NATO and from the United States, as well as a huge uptick in oil. And we're going to get to the oil chart in just a second here. But if you get the huge uptick in oil, what does that also mean? It means the cost of doing business for everybody that relies on transportation costs is going to go up too. So not only do you have war in Russia that will impact the price of oil, but it'll also cause additional pressure on inflation, and it will cause the Fed to have to take more drastic and hawkish actions in order to control that inflation. Now, you have a big wild card out there because there's a lot of rumors talking about an emergency rate hike. And right now, the Federal Reserve is looking really stupid because while we have 7.5% inflation, they're still buying assets. They're going to be buying bonds, printing money, quantitative easing, all the way until the end of this month, guys. And yes, they look stupid. And at the very least, I think you're going to see the Federal Reserve put a halt to all of that, as well as a possibility that they hike rates sometime this week, maybe even as soon as Monday. If I was them, I'd probably hike it 1% right out of the gate because you've got to get a handle on inflation. That's one of those things that can spread like wildfire. But another interesting observation this past week, like the Russell 2000 index, there was a bit of a decoupling in Bitcoin. You saw Bitcoin actually finish higher this week, 0.2% versus the S&P 500 that fell 1.8%. So there's a little bit of a decoupling there, a little bit of a willingness to not track with the S&P 500 and NASDAQ. Now let's flip over to the oil futures and see what we're dealing with there and some of the incredible price increases that we've seen over the last 8 weeks. In fact, over the last 8 weeks, it has been up every single week, going up 40% since the beginning of December. But if you go back far enough on crude futures, and we're talking going all the way back to June of 2015, there is a major resistance level getting broken here. And when it did it this past week, this resistance level, again, goes back about 6 years, that has rejected price on a consistent basis. And last week, we saw price break right through it, and not just break through it, but get the follow on and continuation this week here. And it's news driven with the potential outbreak of war in Ukraine and Russia driving prices even higher. How high do I think it could go? Well, again, let's zoom back out just a little bit here. There's potential for a good size move. And I'm going to pull up the weekly chart as well so you can see what I'm talking about when we're talking about support and resistance. I think there's a clear path to this 110 area, 110, 111. There seems to be some solid potential for a rally. You can see there's been consistent price rejections at that level. And now that we've broken through this 6-year level, there's a price resistance going all the way back to 2011 that I think it has a date with. But now, if we don't have a war with Russia, let's say cooler heads prevail, there's no bloodshed. What are we looking at for the price of oil? I think in the near term, I'm looking at a pullback to 84. And that requires us to go back to the daily chart and see this previous high that was made back in October. I would expect us to see a little bit of a pullback down to this $84, $85 price level if war in Ukraine does not pan out. So to the upside, you got to move up to about 110 before it runs into any real resistance. And to the downside, you have a support level hovering around the $84, $85 mark. But now it's not just oil that we're concerned about here. We're also interested in what the S&P 500 is going to do here, and also with the big tech and Russell indices, because there's been some big moves this past week in those indices, as well as the VIX chart, which we'll also get to. But first, SPY. you've got this head and shoulders pattern that's really standing out to me here. And in the past, head and shoulders patterns haven't worked out that good. The reason why they're becoming more significant right now is because the stock market is on the wrong side of the Fed. If the Fed was still cutting interest rates, this head and shoulders pattern wouldn't mean much to me. But they're actually planning on raising rates, and they're going to start quantitative tightening here before the end of the year, probably before the first half of the year is even over. So yes, I think these head and shoulders patterns for the first time since 2009 have a lot of legitimacy to them right now. First of all, you have a left shoulder, you have a head, and then you have the right shoulder right there. All what you need for a good head and shoulders pattern, but it doesn't become legitimate until it breaks this neckline here. So once this neckline breaks at about 429, then you have your confirmed head and shoulders pattern for much further downside. And for starters, I would have us go back and look at this weekly chart and see where price has consistently bounced off of two very long-term trend lines that are very much important to keep track of. First off, this would be my worst case scenario that I would expect to see. A pullback to the rising trend line off of the 2009 lows. That would require us to get down to about $300 per share on SPY. Big move. You're talking about a 33% sell-off from where price currently sits. Impossible? Not at all. Is it worth really focusing on at this moment? No. The other one is a much more realistic prospect, and it takes into account various points of support and resistance on this chart here going back to the same level in 2009. And that would require us to see a pullback down to about 391, 392. If that level there for the short term seems very possible, especially if we see the rate hikes unfold, war in Ukraine become a reality, and inflation continue to tick higher. On the daily too, it's also worth noting that once again, we've tested the 200-day moving average, and unlike last time, back on February 4th, which saw price bounce off of it, we pushed right through it with little to no support at all for the 200-day moving average, and now we're sitting well below it and poised to retest these lows from January. The Qs have the same kind of head and shoulders pattern, with the left shoulder here, head, and then right shoulder. But on both of these charts, both the Qs and SPY, when you look at it from the weekly chart, it's a very much more well-developed pattern on the weekly chart. Here again, you got the left shoulder, head, and right shoulder. Right shoulders traditionally don't go as high as the left shoulder. On the SPY, you have the same thing. If you zoom out far enough, you can see a very well-developed head and shoulders pattern that's in development going back to July of last year. So on the Qs, we're watching for whether or not the neckline will break. If it does, I'd suspect a move down to 306 on the Qs in relatively short order. And the stocks that are going to suffer the most from it are going to be stocks like AMD. I mean, look at the selling that's already taken place on AMD. 16 straight red bars in a row. That's almost unheard of to see a stock, especially like AMD, to have that many red bars on a 30-minute chart without any kind of a bounce. That's showing you that there's a lot of panic selling starting to kick in into high PE stocks like AMD, which sports a 44 PE, not to mention the fact that NASDAQ 100 sports a 34 PE ratio. And when the markets eventually bottom from severe corrections, you start seeing indices like SPY and like the Qs with PE ratios hovering around 13, 14, 15. And right now, we're nowhere close to that. IWM has a PE ratio of 98. That's the Russell 2000, a PE ratio of 98. So if we see similar corrections across the Qs and SPY, it stands to reason that we're going to see a move back down to 175 on IWM. And then there's the VIX. This past week, huge spike on the VIX. But where resistance is going to become very important is going all the way back to June of 2020. And we have seen a consistent rejection of price at this level here. So can it get above it? It got a little bit of above it here in the beginning of January of this year, but it couldn't hold it for more than a half a day before it finally cracked back below it. Can it close above this level and continue to push higher, much like what we saw during the COVID pandemic? I'm not saying that we're going to see the same exact COVID sell-off. No sell-off is the same. But can we sustain a price move above this massive resistance level that has formed over the last almost 2 years now? In the end, we're in a very dicey situation with the stock market right now. My strategy has been the same. I'm trading lightly. Sometimes I only have 10 or 15% of my capital allocated at any time, mainly to the short side. I recognize the potential for huge bounces. If some of the events that are happening in Ukraine don't unfold, you're probably going to see a good solid market bounce. But I've also noticed too in this past week, everybody's basically talking about how everybody's bearish. But in everybody talking about how everybody's bearish, it actually shows that everybody's bullish in this market. And it's further compounded by the fact that the put option contracts have lagged call contracts by 86%, and it's the lowest in over 2 years. So clearly people are bullish on this market still and haven't really had the rug pulled out from underneath them. And that is a development just over the past couple of weeks during earnings season when people were starting to get a little bit more optimistic about the market, putting in a bottom following the January sell-off. And now we're looking at that all being thrown in flux because you have a lot more headline risk compared to now versus back in January. Inflation is worse. The prospects of war is worse. Oil is even higher, which will drive inflation even higher as well. You take Amazon in its earnings report, they're raising the cost of Prime because of transportation costs as being one of the primary reasons. So transportation is affected by the cost of oil, and if the oil goes up, so does everything else. With that said, let me know down in the comments below, what is your expectations for the week going forward? Do you think we're going to get that emergency rate cut? Do you think they just might say, hey, we're done with the quantitative easing. We're done with adding assets to our balance sheets. That's all we're going to do. We'll wait till the next meeting before we start raising rates. Let me know what you think down in the comments below. Also, make sure to like and subscribe and click the join button so you can get all of my market research each and every day. Thank you guys, and God bless.